All right, first we'll start with the macro view of the economy. We're going to look at the Federal Reserve balance sheet, and then we're going to look at rates because everything starts with rates, and that's what sets valuations in the rest of the market. We had rates climb back up to 4.13 on the 10-year. Think mortgage rates. Mortgage rates are based on the 10-year. So here's the mortgage rate. 6.19. Everything's coming down. But over the last couple of weeks, we've seen this rise again. And just taking a look, 10-year up 3%. Red would be that rates go up because that's a negative. And then if it comes down, you can see where it's green. 30-year mortgage came down. Fed funds rate came down. Fed funds futures, not really a good thing that came down because it's now starting to price out cuts for next year. This is the 2026 Fed funds futures. Government bonds, look at this, a 6% decline in the 1-month T-bill. Remember, they ended QT and they said that when they let their mortgage-backed securities mature, they were going to be buying tons of T-bills. And then you've got the 2-year rate, and then you've got the 30-year. So we did see a decline in TLT, which I'll get into in a little bit because the long end of the curve started spiking again. Take a look at the overnight rate. There's the overnight rate. This is the ZQZ 2026. So futures start about a year and a half out for the Fed funds futures. So about a year and a half out. That's why there's nothing back here. And then you can see it's trading, it's pricing in cuts, pricing out cuts, and so on and so forth. And look, right now we're starting to price out cuts. So 96.91 is what the Fed funds futures, remember it's 100 minus this number equals the terminal rate or equals the rate. In this case, I've got the terminal rate for 2026. So this is what the overnight rate is expected to be at the end of next year. And you can see the end of next year, it is 3.09. Here's another view. There's the QZ 2026 that I'm trading. There's the 96.91. We can see that here when I bring that down, 96.91. And there's 100 minus that is 309, which is putting this December 9th between 300 and 325. We've talked about this before where I believe that is too light. I believe that once you get a new Fed chair, Jerome Powell is leaving in May. Once you get a new Fed chair, I still think it's Rick Reeder, even though on the news and everybody's thinking it's Hassett, still up for debate. Trump hinted that it could be Hassett. I could be wrong. Doesn't really matter. If it is Hassett, he's still very dovish. I don't think the market's pricing in Hassett. I think investors are pricing in someone else. I think when you see Hassett come in, you'll see this potentially fall and start moving back towards this 275, 300. I still think it's going to be around 225 to 250 for the overnight rate. Right now, it's only got 2 cuts priced in next year. You got this one cut, an 86% chance of a rate cut coming up in 3 days. So we'll see what happens there. The Fed doesn't like to spook the markets, so I do expect a rate cut. And then the next one shows in April. And then in July, we'll see how it goes. We also get the summary of economic projections, and that will be an indicator of what the Fed thinks the end rate will be in December. So Wednesday is a very important day to watch. Okay, we have not seen this before, but looking at the option adjusted spreads. So these are the spreads above the treasuries. So here you've got AAA, you've got a lot of corporate bonds. This is how bonds are priced. This is the debt that companies take on. They're called bonds, and they are priced based on several factors. They're given a AAA rating, BBB rating, C rating, and so on. This number here is the spread above the treasury. So a lot of corporate debt is priced at 0.8, which is 80 basis points above the treasury. So think of going back to the 10-year, you're at 4.13. That means this is going to be priced around 5%. So if a company falls in this kind of category, they're going to be about 80 basis points above. And then BBB, you can see about 100 basis points above the 10-year approximately. So you're going to be priced in around 515. If they were to go out and issue bonds and get new debt, they'll be about the 515 mark. High yield. So this is your companies that are a little bit more high risk, but high yield bonds are right now paying 288 above the 10-year treasury. So if you want a little bit more yield than going out and getting risk-free debt for 413, you can go out and add another 3 basis points. You go get some high yield debt, which will put you around 7 to 8%. The issue is it's high yield. It's more risky companies. Not a bad thing. It's just there's some default risk that's priced in, and that's why that premium is a little bit higher. Nothing really to see here. This will go up to 400 or 500 basis points if there's a recession risk. So we'll keep an eye on this week to week. It's been very benign. If there's a recession coming, you'll see this get priced a lot higher. And this will be an indicator of an imminent recession. And then you've got triple C, so think junk bonds like Carnival Cruise, for example, would fall into this category. They've got a lot of debt. Companies that have a lot of debt and have high risk are going to be priced a lot higher. And they're paying 8.78, so 800, 900 basis points above the 10 years. So if you really want yield, but you're going to be taking on more risk, you can now get maybe 12% on some of that debt. So think Carnival and companies that fall in that category. So really nothing to see here. This is not very exciting to watch. So I wanted to give a little bit of a primer on that. And then later on, we'll just flip right through this. But I do want to show you something interesting that happened with the Fed Reserve balance sheet over the last couple of months. We've talked about this before. This white line here represents all bank reserves. So every bank deposits their money at the Fed. I should say most banks. Their deposits, they have reserves. So think of, you've got cash in currency. That's called currency on the Fed balance sheet. And then you've got bank reserves, and that's just all the cash that's sitting at the bank, and all the banks, they deposit their money with the central bank, which is the Federal Reserve. And over the last several years, we've been seeing the reserves bleed off, and meaning money's coming out of the market, money's coming out of the economy. If you remember 3 or 4 years ago, it was very frothy. Now money's tight. We can see that with this drop in bank reserves. There is a number, and we don't know what that number is, what is considered ample. We can infer, based on what happened in September of 2019, that ample reserves are probably somewhere in that $2.5 trillion to $3 trillion mark. The only way you know what ample reserves are is when you start seeing liquidity injections and the repo market starting to increase. And that's what you're seeing here. Take a look at this. Let me zoom in. This is back at the first part of October. And then look, you've probably seen a couple of news articles if you've been watching. They've been talking about the Fed injecting cash. I don't know that it's really the Fed injecting cash. While technically it is, it's because banks are becoming lower on their reserves and they have to have regulatory requirements of how much cash they have to keep on hand. You can tell that the banks are going to the Fed and saying, here, I'm going to pledge my collateral, which is usually treasuries. And in return, the Fed gives them cash. So $50 billion went into the economic system at the end of October. Everything comes down, rates fell. We saw that at the end of October where they dropped rates and it looked like everything was going well. But then look, over the last part, right before QT ended, there was an injection of cash again. And this is the banks are running low on reserves and they have to go to the Fed window, put up their collateral, grabbing some cash. Don't know what banks these are, but just at an aggregate level, they injected another $30 billion in cash. Is this something that's imminent and risky and something that's going to break? Not necessarily. This could take several months, but watch this number because it is plumbing. And once the pipe's clear, we won't know for several months. But this is just showing some clogging up in the plumbing and the framework of how money moves throughout the economy. We'll see what happens in the next few months, and we'll definitely be keeping an eye on this. But this is showing that ample reserves are starting to be hit. We are coming down to that at $2.8 trillion mark, and we do have some liquidity issues. Keep an eye on this. Take a look at one more thing I want to show you. This is the bank money. This blue line here represents money market funds. So there are about 80 money market funds that can't deposit their money like in the banks. So what they do is they'll go out and they deposit with the Fed, similar to what banks do. They get a little bit lower rate and they have all their excess cash gets put into what they call the reverse repo. And it's a liability component on the Federal Reserve balance sheet. And that number has been declining. You can see way back here during COVID, there was a lot of excess cash. Everything was post-COVID. A lot of excess cash, and that got bled off. And now we're only at $1.49 billion. That means money market funds, GSEs, government-sponsored entities like Fannie Mae, Freddie Mac, they don't have the excess cash to put in here. Now, it's not saying they're running out of money. They still have cash. It's the sideline cash. It's the excess cash that they would put to work. This here is the TGA account, the Treasury account. Think of the IRS and everything that comes out of the TGA. The Treasury puts their money with the Fed as well. And Scott Bessent said he wants to keep the TGA account at around the $800 billion mark. What's interesting is you had the government shutdown. So yeah, you definitely had an increase in the deposits on the TGA because they weren't paying out anything. And then they paid out, but it wasn't very much. When the government paid out, you can see it's at $983 billion. And by the end, it's $899. So $100 billion, right? $100 billion. But look at the amount of money that's in the banking system from that same time. So from 2.85, let me just draw it from there, 2.85 to 2.86. So you'd expect if there was a giant payout here, which everybody did, there's still too much money coming out of the system. So what I'm saying here is the money did not go up by 100 billion here. It only went up by like 10 billion. So that's problematic. It did get spent still in the banking system, but there's still a big drawdown just overall. I know that was super confusing. Let me see if this helps. This right here is the Federal Reserve balance sheet. This is as of March. Treasury securities, mortgage-backed securities, emergency loans, repos. This is these repo facilities. This is the cap. Right now it pays 4%. Bank reserves pays 3.9. Reverse repos on this side of the balance sheet is 3.75. Let me show you something else that's interesting. If I haven't confused you already, let's see if I can confuse you some more. Okay, these are the interest rates that the Fed uses to control where the effective Fed funds rate is. This white line here in between is every time that they're dropping rates by a quarter or by 50 basis points, you can see this white line drop. That's the effective Fed funds rate. What ends up happening is if you look at the standing repo facility that we looked at on that balance sheet just a minute ago, this is that top blue line. This is in place, and it started in 2019 after the September monetary crisis that nobody really knew about, unless you were following this. The blue line is, this blue line is if banks have to borrow from one another and cash gets expensive, the Fed says, hey, I got a standing window here. You can go and borrow money from me instead of borrowing from other banks. This blue line here represents what banks borrow from each other. It's called the SOFR, Secured Overnight Financing Rate. For this purple line, this dashed line, this is what the Fed pays banks. And this red line here is where you pay excess cash. It's the floor in the reverse repo facility. So if these money market funds and things like that need to park cash, this is what helps support that. And that's the reverse repo side on that balance sheet we looked at a minute ago that pays 3.75. What's interesting though here, let me explode this up a little bit more. This to me is pretty fascinating. Look at this white line here. You see how it's starting to creep up? It's starting to creep up to this blue line, but also look at this light blue line. That is banks borrowing from each other because they need cash. And look, it spiked. They ended QT right at this part because they're seeing this become decoupled. That white line never moves. If you go back several years, that white line is not supposed to move. What this is telling us is as this white line, the effective Fed funds rate, gets closer to this 3.9 rate, what they're paying, it means money is getting scarce. So you can see that in this blue line here, what banks are borrowing from each other, the cost of money. This bank says, I don't have it. This other bank says, I don't have it either. I have some of it, but I'm going to have to charge you a little bit more. And they increase the price and it goes up very quickly. So the Fed said, we'll put in the standing repo facility, this blue line here. And they said, you can just come to us and we will cap the rate. All right. So they lowered the rates. We saw that. You see liquidity problems here. Now look at it again. This white line here is starting to go up. This is why the Fed will cut rates, because they need to start spurring and they need to see the bank reserves. They need to see that grow. If it gets down into this yellow area, you will see a lot of problems in this, and then it's going to create some macro problems. Now, does this all mean that rates are going to change tomorrow? No, but it's definitely something to keep an eye on. But anyways, as this white line creeps up, money's getting tight. Money is getting tight. Keep an eye on that. One last thing before I move on. Let me show you back in September of 2019. This is what I was talking about. So we started seeing liquidity problems back in 2019 as well. And look, banks started borrowing from one another. Money markets shot up to 10%. Nobody really knew about it unless you were in finance. This is what the Fed is trying to solve by implementing. And you can see that blue line here. That's the standing repo facility that they implemented. And that keeps that from happening. So this is how the Fed's called the Fed corridor. This is how the Fed controls rates. This is the plumbing underneath of how they keep rates consistent. And we will see. Keep an eye on this. Moving on from the Federal Reserve, what happened this last week? Really not a whole lot. We got the ISMs, manufacturing services, came in where expected, didn't really move markets much. You did get PCE. Nothing really to look at here because this is old data. With the government shutdown, it's old data. Came in as expected on the core PCE. You got Michigan consumer sentiment, 53. So a little bit better. People are feeling a little bit better about the economy, but really not enough to move markets. All right, so let's go into the market itself, the SPX. Earnings, 296.15, makes your PE ratio 23.2, and as we've seen before, every time it gets up to that 23 mark, you see a pullback. So it'll be interesting to see if you really get a pullback. We talked about a couple of weeks ago, I was out last week during Thanksgiving, but a couple of weeks ago, we did hit this spot here, and I started selling puts. And I mentioned that the market was probably going to go up from here, and it did. It went up very nice, about 5% or so in the last week and a half. We've only got 2% to go, less than 2% to go to hit that 7,000 mark. Would not surprise me one bit we hit 7,000. But with this 23.2 PE ratio, that is high. It's high valuation, but valuations don't seem to matter right now. The market just thinks it should go up. From a performance perspective, this last week we had S&P didn't really move that much. It was very flat. I expect it flat in the next couple of days because everybody's going to be waiting for what the Fed says on Wednesday. Russell 2000 still climbing. This one had a 5% week last week and then another 1% this week. TLT, we did have a pullback on the long end of the curve on the 20-year rate. So back 2.26%. I am selling puts. Home builders did have a little bit of a pullback. They're still around 108, 109, just overall home builder ETF. AG&C, man, is it on fire. About 1062 is what it closed out on Friday. So look, 15% for the year, not including the dividend of 14%. So very good. And then live cattle continues to climb. Looking at a few of the technical indicators, our put-call ratio. So people are becoming less fearful and still more puts are being bought than calls, but not at the same rate. So you're seeing a rollover. This is a buy signal. Put-call ratio is now on a buy signal. Your new highs and new lows, so another market breadth indicator, also on a buy signal. MACD, moving average convergence divergence, is also on a buy signal. A lot of support for bullishness. Look at market breadth, another market breadth. We saw it drop down to about that 30% mark. And remember, I told you if it gets down to that 20 or 30% mark, that's usually a good indicator. So stocks above the 50-day moving average, now 50%, 54%, and the 200-day moving average right around 59%. This is not a sell, nor is it a buy. It's right in the middle. As market breadth continues to improve, you would see this likely rise. And then once that gets up to that 70, 80, 90% mark, that becomes the sell signal. So you're right in the middle, really neither not buy nor sell. Look at VIX, your fear gauge. I mentioned a couple of weeks ago we were on a buy signal. You are still on a buy signal. You've got low volatility, almost to yearly lows. You're at 15.4, where the yearly low is around 14, so you don't have much further to go. I would expect this to fall in the next couple of days because there's not going to be much happening. Everybody's keeping their eye on the FOMC on Wednesday. Overall, the market's bullish. More bullish indicators than not. The only thing to be cautious about is the PE ratio at 23.2. That's very high. We are also hitting a resistance line here. So previous all-time highs, right, at around 691, and we are at 687. So it looks like it tried to get up there the other day and then pulled back. This is a very important line to watch. If it breaks above that for a couple of days, you can see it go to 7,000. If it holds, you'll see a pullback. But I expect the next couple of days it's going to hang in here. This is just technical analysis. It doesn't mean a thing because FOMC is going to be what matters and what they say in the presser at 2 o'clock Central Time on Wednesday. Speaking of what's coming up this next week, we've got job openings coming up on Tuesday. This is an important number to watch. Again, it's probably going to be benign. We're seeing some weakening in this. It probably won't move markets that much unless it really comes in weak. This could be a market mover, but most likely not. There is the Fed interest rate decision. You get the summary of economic projections. This will let us know what they're thinking and the divergence between what all the Fed people are thinking. And we know that there's some disparate thinking within the Fed. It'll be interesting to see who becomes Fed chair and how this all changes. There's the press conference. This is where it's all at. Then you get PPI on Thursday. Not going to probably matter because the market will still be digesting the Fed decision. And that's all we really have coming up this week from an economic standpoint. Let's take a look at earnings and see what's coming up. Kind of going back to the first part of the week, you've got Toll Brothers. I probably won't play that one. These are some small companies. I don't usually play anything that's in the hundreds of millions. I usually like to play a little bit larger stuff. Korn Ferry, probably not. Academy, probably will play that one. So I'll look at them and see if they meet my criteria from a volatility crush standpoint. AutoZone, maybe. Cracker Barrel, this one would be an interesting one to watch. I will probably play this one because volatility will be super high on this because everybody's going to be expecting like what happened with the whole marketing debacle that happened and still the fallout from that over the last few months. So even though they're small, I will probably play that one depending on volatility and the pricing of volatility. GameStop, I'm not going to touch it. Dave & Buster's. Chewy's, maybe. Looks like Oracle. This does meet my criteria. I'll go into that here in a second, so probably play that one. And that's really about it. And then look at next week. We've got some put sales that we could play this week. I will probably play Lennar. We've had looks like some movement in Lennar, so I will be playing that one. It'll meet my criteria from a put sale perspective, and General Mills also, which means that what I'm going to do is I'm going to sell puts, which tells the person I'm selling the put to, hey, I'll buy your shares if it hits this price. But again, a lot of times the companies don't move as much as expected. So therefore you can sell puts, collect the premium because they're going to pay you to take on that risk. And then I'll just collect the premium and walk away. I have been, for the last several quarters, 100% successful. When I say 100%, meaning overall for the quarter, I've made money every single quarter playing put sales. Now, some individual companies, General Mills, what if it went against me? I might lose on that one, but because at the whole, I'm still making money on all the rest. But these are good candidates to play. The other thing I will be looking at is my Bollinger Band indicator, where I modified the Bollinger Bands and I've wrote my own indicator and said, tell me when it's on a sell signal. Tell me when it's on a buy signal. So these two came up today as sell signals. So let's take a look at D.R. Horton. If you remember, a couple of weeks ago, I mentioned D.R. Horton was a strong candidate to sell puts on. And so I sold puts at around the $131 mark. And right after that video came out, the DHI actually shot up about 10%. Maybe I had something to do with that. I doubt it. I'm just playing. But anyhow, it came up as a strong buy signal. And then it's coming up now on a strong sell signal. So it looks like it might be slightly overbought. There it is. It's slightly overbought. My indicator looks at standard deviations. So it is coming up on a strong sell, which means I will probably move and sell some calls up here, which means I'm telling the person I'm selling the calls to, hey, look, I'll short it, if you will. So I'm taking on the risk that if it goes up too much higher than this, then I'm going to lose. But given these strong sell signals, you can look, here's one. I'm only going to sell these for a week out. So I've got 3 or 4 days for it to work in my favor. And then I'll walk away and I'll collect that premium. So that's coming up on a strong sell. And then the other one is Devon Energy. Let's take a look at this one. And I will look at it on Monday and see if I get any kind. If it starts going back up, I may not sell this one, but my indicator is saying it's a good candidate to sell. So if you're interested in this indicator, let me know. Shoot me a note in the comments or send me an email. The other ones that I'll be playing are some earnings crush plays. These are the companies that met my criteria. Some of these are reporting earnings, and then some just have high implied volatility from one week to the next. But they did make my list, and I will be looking at those. So Oracle, Campbell Soup, and Adobe, I will probably play those because they definitely meet the criteria, and I'll report on that next week. All right, and then finally, the last thing I'll be doing is I will be selling volatility for the next couple of days. So we have very low volatility. Normally, I don't like to sell volatility when it's this low. You end up having to straddle the market or what they call strangle the market, where you sell a put and a call far out, 20 delta from the current price, and probably like a month or so out. I probably won't do that this time. What I'll do is I'll probably be selling a few days worth of volatility, meaning I'm only going to go out a few days, sell the volatility for Monday and Tuesday, because I don't expect a whole lot of market movement on Monday and Tuesday because everybody's going to be waiting till Wednesday. So when I talk about low volatility, this is my Schwab account. And the number I'm looking at here, so if you look at the 8th, 9th, 10th, look at the volatility here. So the market's only expecting a $3 move, if this is SPY, a 3-point move up or down. And then on Tuesday, a 5-point move. On Wednesday, a 7-point move. That's not that much. So this volatility, 11%, 12%, 14%, is not a whole lot to work with. But given that the market is waiting for Wednesday, I will probably sell a little bit of this volatility, and then I'll hedge it. I'll hedge it so that if I'm wrong and the market moves a ton, I at least won't lose a ton. But again, I don't expect a whole lot to move. And then on Wednesday, right before the Fed, I may Wednesday morning, maybe around lunch, I may buy volatility. Again, right here with a 7-point move, what if it moves to 10 or 15? You can take advantage of that by buying volatility, and that's where instead of selling volatility, and you're hoping that the move stays within, you buy volatility and you hope the move goes way beyond. The problem with buying volatility, you have to be very careful, is theta, which is your time decay, can go against you very quickly. So let's say you're buying a week out, you're buying volatility, you might spend, let's go out a week, let's go to December 16th, 17th, 13-point move. If you were to buy that on SPX, you're going to spend $13,000. Not a big deal, but you need it to move more than 13 points by expiration to make money. You can also just have it move a few points one way or the other in one day, and you can still make money. But if it stays dead center and it does not move at all, you're going to lose like $1,000, $2,000 a day. So that is where you have to hedge it some other way to pay for that loss. And that's what I will be doing on Wednesday, probably Wednesday morning, maybe around Wednesday lunch. I'm going to take a look at the volatility. I will buy it, but I will hold it very little, hoping that if the Fed says something that spooks the market one way or the other, summary of economic projections, something doesn't come in as the market expects, with it being so cheap, and $13,000, believe me, is cheap, and it moves, and you can do very well. So I'll see. Don't follow me. This is something that I like doing, but it is risky, and we'll see how it works out. I'll let you know. The other thing that I will be doing is buying ZQZ. So we talked about the terminal rate, only 2 cuts being priced in. We talked about that earlier, 96.91. That's 309 on the terminal rate. I think that is way too light. You can see over the last 3 months, it pops down here because everybody thinks that there's 2 cuts priced in, and then all of a sudden it'll go up to 3 cuts priced in. So what I'm doing is I started buying when it pulled back and it got into this 96, and then I bought again at 96.91. If it pulls back any further and I get a 96.88 or 96.89, I will buy again because that is the bottom. I don't think you're going to see any less than 2 cuts, but I certainly think you're going to see more than 2 cuts. So for me, it's a low risk trade. I will buy that. If we get another pullback, I have 3 contracts right now. I'll probably buy a 4th if it hits here. And hopefully it'll hit there Monday or Tuesday before the Fed speaks, because I think that'll be when things start pricing in another cut. And depending on who gets elected or chosen for the Fed chair, you'll see the narrative shift. Trump is expected to announce that next month. So let's see when that happens, and you'll see this will pull back. This will go up again. Now the question becomes, depending on what the narrative is, do you hold it and sell it again when it gets up to this 97 mark, which is a 10 basis point move? Or do you just say, look, this is a long-term trade, I'm going to hold it? I don't know, because it depends what the narrative is. If the narrative is very strong, I'll hold it and I'll just wait, because if I'm right and it goes down to that 250 mark instead of 309, that's a 59 basis point move. For each contract you have is $41 per basis point move, which is about $800 per quarter point getting priced in. So on 4 of those, 1 cut being priced in, $3,200. It's not a lot, but it's a low risk trade for me. It'd be the same if I was wrong and only 1 cut gets priced in, then I can lose $3,200. So not a big deal. To me, that's a very low risk, high reward trade. Finally, we talked about IWM. IWM is your small cap Russell 2000. I've been selling puts all along the way. When it goes down, I sell puts usually for 1 week, and then it goes up. I keep the premium. And then when it dropped down to this 230 mark, which is, remember, that's like almost a 10% pullback, I tripled my puts when I took that risk, but volatility was so high, premiums were expensive. So again, if you want to know how to do this, look at one of my videos on selling puts during earnings season, and it'll explain how to sell puts, and how to collect that premium. And that is really it for the week. I hope you enjoyed this video, and let me know. Happy trading, and we'll see you next week.